That tweet sort of points to what some worry about, and that is you get a recovery in the markets, president feels like he can be a little tougher, and hence a trade deal gets pushed out, perhaps. You buy that?
A little bit. It's the same with the Fed. You know, you could argue that as the market recovers, the Fed's going to get less dovish. Although yesterday, certainly that was not the case. You know, my assumption is that this is a very long-term containment strategy by the U.S. and that we shouldn't celebrate the individual wins too much, because even if there is a deal, quote unquote, the next day there could be something new happening that kind of takes the punch bowl away again. So my base case assumption is to have low expectations, and if they're exceeded, great, maybe we boost earnings a little bit, but earnings growth is slowing pretty dramatically actually, and I think part of that has to do with trade and the fact that a lot of orders were kind of front run in anticipation of tariffs, and now we're going to see the other side of that.
So what is your expectation for March 1st? I mean, is it sort of this, we're going to buy some soybeans and then we're going to talk about the tough stuff later?
My guess is yes. It'll be some sort of détente, but it's certainly not going to be the end of the story. I think this is a very long-term story that's going to continue to play out over the coming several years, probably.
What's been your take so far, about a third of the way into the quarter, not on results themselves and beating, missing, but the guidance?
Yeah. So the guidance, I think, is okay. It's kind of what we would expect. You know, earnings peaked last year at 24%. The third quarter was at 26%. The fourth quarter, which is now being reported, it's looking at around 13%. 7 out of 10 companies beating by about 1.5 percentage points on average. But the calendar year 2019 estimate, you know, is falling pretty rapidly. It was at 12% in terms of year-over-year growth a few months ago. It's down to 6%. It's falling by about 0.5 percentage points a week. So we'll be lucky to get kind of 0 to 5 this year at the rate that estimate's coming down. Now, it always comes down, right, because the expectations always start too high, and then companies guide lower, and then they, lo and behold, beat the number that they guided lower. So we're seeing that same game play out, but it's looking to me like a low to single mid-digit year in 2019.
Back to the patient Fed for a moment. You think they'll raise interest rates at all this year?
My assumption is that the Fed is done. If growth lives up to the Fed's expectations and the economy continues to grow above potential, which is certainly where it was last year, then maybe they put another hike or two back on the table. But my assumption is that the Fed basically is saying we're neutral. Maybe we go up down the road, maybe we go down, and that really the balance sheet is the key ingredient, and that I think is what the markets were cheering yesterday and what the markets were jeering back in December during that press conference. So it still comes down to what is the value of quantitative tightening. If that's a surrogate rate hike, how much is it, and is the Fed still too restrictive? My sense is that it's not, that the economy is in good shape, led by the consumer, that there's no recession in sight for the U.S., and that the Fed possibly could go a little bit more, but I think for the next 6 months, we shouldn't expect anything from the Fed.
But are you in the school that says there is quantitative tightening coming, even if they don't hike, even if they cut? There's a form of tightening, or is that, as Jim said last hour, too inside baseball?
It's a little inside baseball, and it's poorly understood and poorly explained as well by the Fed and by others in terms of what this actually means. Nobody really knew, right? I mean, QE was uncharted territory. QT is as well. Maybe it's not a linear thing in terms of what quantitative tightening takes away that quantitative easing gave us in terms of the market. So nobody really knows, but as long as it's shrinking the balance sheet, I think it is some form of tightening. How much and what it means is a different story, but it does presumably reduce liquidity in the system, and that is by definition a form of tightening. Right.